According to online property portal Zoopla, people selling their homes are being forced to settle for below asking price, fueling the fear that a property market crash could be on the horizon. But with all this fear comes the question, should you buy a house now or wait? Hi guys, and welcome back to another video. I hope you're all doing well. As always, remember to hit that like button and hit that subscribe button. Without further ado, let's get into today's video. Now, with the cost of living crisis, higher interest rates and record high property prices, it can be really difficult to know what to do when it comes to buying property. To buy or not to buy is the question. Now, of course, the answer will always depend on a vast number of things. But in my opinion, there are two core different categories, and the general answer across the board will differ depending on if 1, you are an investor looking to buy a buy-to-let or any other kind of investment property like a HMO, and 2, are you a buyer looking to move or buy your first home. For investors, it has been a tricky year or two. Record high property prices and higher interest rates mean finding properties that deliver an adequate return based on the amount of risk you are taking has become significantly more difficult. It's also become a lot more competitive, with high yield areas such as the north attracting southern money. This in turn has led to higher property prices and a reduced yield. But not only that, it led to properties selling before they even hit the market. So, should you buy an investment property now or wait? In my opinion, for a property investment to make sense, you need these 5 things. Number 1, a motivated seller. Number 2, a property located in an area with strong rental demand. Number 3, positive cash flow. Number 4, long-term capital appreciation. In most cases you want this. And number 5, and finally, all investors need to have a cash buffer. If you have these 5 key things, then it is my opinion that you would be better off buying the property now than waiting. There are of course caveats that come along with this. For example, is the yield high enough in relation to the amount of risk that you are taking on? Just because it cash flows doesn't mean it's a good investment. Okay, so why do I say buy now instead of waiting? Despite all of the economic uncertainty and talks of a housing market crash, it is almost impossible to time the market, and those who have tried fail 99% of the time, and those that have actually succeeded in timing the market have done so by sheer luck. Now, if we take a look back over the last 100 years, there have been 4 significant crashes. We had the 2008 financial crisis. The biggest fall in UK house prices in recent memory was brought about by the financial crisis of 07 to 09, which occurred as a result of the deregulation in the financial industry and most notably mortgage brokers in particular, with property prices falling an average of 15% across the country. And 2008 also saw the biggest recession since World War II. The early 1990s recession. In 1989 and the early 1990s there was another period of economic downturn thanks to the US savings and loan crisis. Restrictive monetary policies were introduced by banks and building societies to curb record inflation, and the end of the Cold War and the 1990 oil crisis in the wake of Iraq's invasion of Kuwait all led to this downturn. In the UK, house prices had seen an artificial increase as a result of prospective homebuyers rushing to purchase property prior to the withdrawal of the MIRAS tax relief option in August of 1988. Then we had the mid-1970s. Now, despite there being a boom in home ownership and rapid property price growth from 1971 to 1973, the decade also saw widespread political and social unrest. The 1973 oil crisis and Yom Kippur War, which was between Israel and a coalition of Arab states, and the industrial action of coal miners and railway workers at home, which led to the infamous 3-day week, all resulted in a lengthy recession lasting from 1973 to 1975. This saw house prices become stagnant as high unemployment and high inflation occurred in tandem. Although things did pick up again in the 1980s, with prices rising an impressive 16% and 25% respectively in 1987 and 1988. The 1950s downturn. House prices in the post-World War II era of the 1950s declined by about 7% and was one of the most significant declines of the past 70 years. This was the nation's first downturn since the Great Depression in the 1920s, following a house building boom in the 1940s and early 1950s. By 1956, the UK was experiencing both economic and political unrest and setbacks, such as increased inflation, unfavourable bank rates, and the Suez Crisis. And finally, we have the Great Depression in the 1920s. Although we were not as badly hit here in the UK as the United States, where property prices actually plummeted by around 35% by 1932, the UK did experience a brief recession from 1921 to 1922, which had a knock-on effect on house prices. Because remember, when the US sneezes, the rest of the world catches a cold. And between 1926 and the outbreak of World War II, the average UK house price only increased by £40, from £619 to £659. In contrast, the average house price rose from £2,000 to £5,000 between 1950 and 1970, and then doubled between 1970 and 1973. So why am I bringing all of this up and giving you a history lesson? Well, the reason is because despite every single one of these downturns, we are still today at record high prices. So the old saying, "Don't wait to buy property and wait," rings true throughout history. Now, of course, just like anything, you don't want to overpay and just hold and hope for the best. But if you plan on buying and holding a property for 10, 20, 30, 40 plus years, you shouldn't be worrying too much about where the property market is going in the near term. What you'd be far better off doing is thinking about the 5 things that I listed a little bit earlier on in the video, and then going a little bit further, examining the property and its location in a little bit more detail so you know 100% that it is a good deal. Okay, now what about those of us who are looking to buy a home to live in and not use it as an investment? Well, if I'm being totally honest, everything I have said already in this video rings true in that situation as well, with a few minor differences of course. For example, you don't need to worry about whether or not your property cash flows and the yield that it returns. But that being said, I think there are a few things that home buyers should be doing that property investors do very well, and I think if they were to follow some of the things that property investors do well, home buyers would be saving lots of money and not losing money on their properties. So number 1 is assess the true value of the home before buying it. Learn what the actual market value of the property is and what they go for in your area before putting in an offer. Because although you are not worrying about yield, it's not a good idea to overpay for something just because it's a home to live in. Remember, money in property is made when you buy, not when you sell. Number 2 is do not over improve your home. Far too many homeowners spend way too much money on fancy fixtures and fittings, extensions and conversions than the house actually requires or needs. Now yes, I understand that as a home you want it to look and feel nice. However, do you actually notice the difference between the £50 tap and the £200 tap? Probably not. In most cases, you can buy almost an identical version of the most expensive thing for way cheaper. So why is this important? When it comes to property, there will be a maximum that you can sell the house for based on the comparable properties on your street. You will not get more than the highest possible maximum for your street, no matter how many extensions or fancy fixtures you put in or onto the property. You just won't be able to sell that house for more than the street allows. Most people will come to sell their home when they need to move. So if they want to upsize, for example, and all you're doing by over improving is reducing your potential profit on the property when you do come to sell. And finally, tip number 3 is to use a mortgage advisor. As much as you might not want to pay or even really understand the benefit of a mortgage advisor, they are 100% worth the cost. Because if you add up the actual cost of using a mortgage advisor and then compare that to the interest that in most situations they will save you across the lifetime of your mortgage, the mortgage advisor in most cases will pay for themselves many times over. And that's just talking about interest alone. We're not even talking about the time or stress of handling a mortgage on your own here. Well guys, there we have it, a slightly different style of video today. Remember, none of this is personal financial advice. If you are looking to buy a property to live in or a property for an investment, speak to a financial advisor, speak to a mortgage advisor and take your own financial advice from them. This is not financial advice specific or personal to you. With that in mind, I hope you found this video useful and insightful. If you did, remember to hit that like button and of course hit that subscribe button. We are growing faster than I could ever have expected, so thank you every single one of you for that. And until next time, I will see you in the next one.